Hello, good afternoon, everyone. Myself, Dr. Kushbu Pandya. Today, let's start with chapter capital restructuring. Now, capital restructuring is a process where a company is a loss-making company and has to transfer or convert it into a profit-making company. Okay, to get it into a right track. So where it's an internal arrangement, okay, that gives a new look to a capital restructure where adjustment to the rights of the shareholder, debenture holders, creditors, and along with that some adjustment in valuation of assets, okay, and the surplus been generated will be write off for losses and fictitious assets. So capital restructuring is a transfer, okay, where there is a reduction in a share capital. For capital reduction, the company have to take confirmation from the tribunals, and various legal proceedings are there where it should be the company's detail like this going for internal reconstruction or capital restructuring should be there in articles of association. Okay, then company has to take approval from the creditors like the debenture holders. Okay, company has to comply with the all the norms of the Companies Act, and as well as has to give the public notice for going under capital restructuring. Now, under capital restructuring, there are two types: internal reconstruction and external reconstruction. Now, under internal reconstruction, there is a internal adjustment where company is just transferring their transferring the shareholders, okay, or the reduction in a share capital, okay, offering a new capital structure to the existing shareholders, equity shareholders and preference shareholders. Okay, as no new company comes into an existence under internal reconstruction, whereas external reconstruction is there, the process results into a formation of new company. Under internal reconstruction, there is a revaluation of assets and liabilities because assets are overvalued and liabilities are being paid off. Okay, creditors and debenture holders are being paid off. As this in external reconstruction is concerned, there is a transfer of assets and liabilities. If we talk about into an accounting process, under internal reconstruction, we open capital reduction account, whereas in external reconstruction, we open realization account. Now, as internal reconstruction result into restructuring of existing capital structure, so no new companies form. But into an external reconstruction, there is a formation of a new company. Okay. Now, as internal reconstruction, the sick making company or loss making company goes into a internal reconstruction. Okay. So under internal reconstruction, it is under Companies Act where section 61 to 66 are there. Now, as the advantages, okay, as there will be a formation of a new capital restructuring takes place. Okay, so where there will be proper true and value of the financial statement would be generated as the assets are overvalued. So under this, there would be enhance in profitability, okay, improved financial stability, okay, where company will achieve a better sustainability, financial sustainability through internal reconstruction that involves changes in their operations or capital restructure. So reconstruction can help the companies, okay, to increase their profitability. Now, as there are different types of internal reconstruction, as there will be a reduction in the uh, paid up value where nominal value will remain the same. There will be change in the paid up value. Second category where there will be a reduction in nominal value as well as paid up value. Okay. Third would be consolidation of shares. Okay. Consolidation of shares, then subdivision of shares, conversion of shares into stock. Okay. So these are the different types where company can go for internal reconstruction. Company can adopt any one of it. Now, under capital reconstructing, where the first of all, the existing equity share, fully paid up equity shares, preference shareholders have been restructured and offered at a new paid up value or nominal value. Their surplus is being transferred to capital reduction account, and this amount has been utilized for writing of the losses as well as fictitious assets. After that, existing debenture holders are being offered a new debenture holders, okay, at a new interest rate. There would be revaluation or valuation of assets, okay, where the assets have been overvalued. Okay, such losses been transferred to capital reduction account. So capital reduction account is nothing but it is a nominal account. It is like a nominal account where if there is a increase in reduction in value of assets and increase in the value of liability, would be recorded in capital reduction account debit side. Okay, and similarly, if an increase in the value of assets and decrease in value of liabilities will be recorded in the credit side. Okay, capital reduction account, credit side. So it's a like basically a nominal account. So debit all the losses and credit increase in the value of assets or reduction in the value of liabilities. Then we are in case any value have been there is a sell in value of assets. Okay, so if there is a sell in the value of assets compared to book value, if it is higher value, then definitely there would be a profit transfer to capital reduction account. If the sales value is less than the book value, a loss that would be recorded in capital reduction account debit side. So all the this losses and fictitious assets would be transferred to capital reduction account debit side. Okay, at the end of it, it will be write off and your capital reduction account should get debited. In case if any balance, there is a surplus or a capital reduction credit balance is higher, then it will be transferred to capital reserve account. Okay, so capital under internal reconstruction, this entire process takes place. Okay, wherein in the question you'll be having the balance sheet. Okay, and adjustment would be there, and we need to give the posting of the journal entries as well as give the effect of the adjustment, prepare capital reduction account, and after internal reconstruction adjustment or incorporation of the scheme, we need to prepare post balance sheet. Okay, after the adjustment of internal reconstruction. So now in this process, if there are any contingency liabilities been foregone, okay, that has been waived, then we don't have to give any entry for the same because it is unrecorded liability. Whereas if any liabilities are being paid off, Okay, definitely the entry would be the payment, either it would be payment towards loan or creditors, or even debenture holders have been paid off. So we have to record it accordingly. So this is the entire process of internal reconstruction. Uh, the there's similarly this external reconstruction is a different process where there is a different types, like it takes place like amalgamation, okay, absorption, and external reconstruction. Okay. But internal reconstruction takes place within the company itself, okay, restructuring itself and coming back or giving it into a profitable one again after this entire scheme of internal reconstruction. Thank you, and we'll be posting out further with few illustration.
We are recording.